Imagine this. Meet Raj, who moved from Canada to Dubai 3 years ago. He sold his former Toronto home for $820,000. So he lived in that house as a primary residence, and 3 years ago he converted it to a rental. On the closing day, Raj expected a large wire transfer of money in his bank account. Instead, his lawyer called and said the Canadian Revenue Agency or CRA is holding back $205,000. Raj asked, "Wait, why are they keeping quarter of my entire sale price?" Here is what every Canadian living abroad and every buyer needs to know. The background story is Raj is still Canadian citizen, but for the tax purposes he is now considered non-resident of Canada. Many people don't realize that citizenship and tax residency are not the same thing. Under the section 116 of Canadian Income Tax Act, when a non-resident sells Canadian real estate, the CRA or Canadian Revenue Agency wants to ensure any taxes owing are paid before the seller receives all the sales proceeds. If the seller does not obtain certificate of compliance at the closing, the buyer may be legally required to withhold 25% of purchase price for many residential properties across Canada. In some situations involving business use or certain other property types, the withholding requirement could be as high as 50% of the purchase price. This money is often held in a trust of the lawyer until the CRA completes the review of the transaction. Let's review Raj's number. Sale price of his property was $820,000. Without a certificate of compliance from CRA at the closing, 25% of $820,000 equates to $205,000 that could be withheld at closing. But here is the surprising part. That does not automatically means Raj owes $205,000 in taxes. Suppose from his primary residence to when he sold the property, his capital gains was $100,000. 50% is tax exempt. So whatever $50,000 is left, roughly 25% of it was his tax that he owes to Revenue Canada. After filing the required CRA forms, filing the tax return, the remaining approximately $175,000 may be released or refunded, assuming the calculations support his claim. That's why planning early can make a huge difference, and why timing matters a lot when we as a listing agent or a buyer agent represent our clients. If we find out ahead of time that seller is not residing in Canada, we put a special clause to protect our clients. And in this case, the biggest mistake is waiting until closing. So if you're a non-resident seller, talk to your lawyer ahead of the time and tax advisor when the property is listed or as soon as the offer becomes firm and binding. The CRA application for certificate of compliance could take several weeks, so starting early may reduce the delays and unnecessary holdbacks at closing. So also remember, you must first still file Canadian income tax return reporting the sale of that property. If you're previously renting the property, additional reporting requirements and obligations may still apply. At the end, the bottom line is, if you're buying from or selling as a non-resident of Canada any property, don't assume everything is simple and routine. One overlooked tax rule could delay the closing, tie up your hundreds of thousands of dollars for months, or create unexpected legal responsibilities. Always speak with an experienced real estate lawyer and qualified tax professional before closing. My name is Jimmy Singh. I'm broker of record, owner for Fortune 2 Realty in Ontario. Follow me for more Canadian real estate tips and pointers that could save you thousands of dollars. If you're first time on my channel, subscribe. And if you have any questions in regards to buying, selling real estate, how is the market, my number is on the screen, 647-961-2639. Thanks for watching.